Hey everyone, good afternoon. It's Denise Donahue, your favorite mortgage nerd, and I am so glad that I have finally put together this presentation about interest rates. Every client I meet wants to get the lowest interest rate, not the highest rate, and what's really important to me and the team is that we educate our clients about how the rate market works today versus how it worked back in '08, and that we're as transparent as possible. So I recorded this video so that you can follow along with me. If you have any questions, you are more than welcome to give me a call or send me an email, but I just wanted to give you more of the behind the scenes of how the interest rate market works. So let's jump in. What you'll notice here is that before, in the time period of 1938 to 2009, there were basically two types of loan programs. You had conforming, and then you had the subprime. And the subprime is what everybody talks about. That's what got us into trouble in the '08 or in the housing bubble. But essentially, if you were able to qualify for a loan and you could provide income verification and asset verification and all that stuff, then you got a really good interest rate. And if you were subprime, meaning you just stated your income and the lender didn't verify anything, so literally if you haven't bought, if this is your first home purchase back in the day, you could just say you were a VP at such and such company and you make $200,000 a year, and lenders didn't have to verify that. Then you got whatever rate the bank wanted to give you. And so that doesn't work in today's world anymore. Basically, since 2009 to present, rates now follow a scorecard, and it's called the loan level price adjustments. And basically, what conventional loans look at is this 30-point different scorecard so that you can see all the different factors that are analyzed when looking at what your interest rate would be. And if you notice, there's things on there like loan amount, the loan term, whether you're doing a 15-year, 30-year, the type of loan that you're doing, like conventional USDA, if you're getting cash out, if you're buying or refinancing, where the property is located, the type of property it is. So if it's a single family home versus a condo, and then of course what everybody expects is the credit score and the down payment. But there's a lot more that goes into it than just credit score and down payment. And many people don't realize that. They'll call me and they'll say, well, Denise, I've got an 800 credit score and I'm putting 20% down, so do I qualify for the lowest interest rate? Well, there's a lot more than just that. And so what we do is we look at this entire scorecard and we say, okay, who's going to give us the lowest interest rate? But what I want you to start thinking in the back of your mind is when you call a bank, or if you're surfing the internet, or you walk into your bank and you see their advertisements and it says that you can get an interest rate of this percent, what do you think that they're doing? If they don't have the scorecard, how accurate is that rate? It's just a marketing or advertisement. That's why in the bottom there's a paragraph that's this big that has a bunch of fine print that says you either have to be a unicorn to get that interest rate, or it says this is based on assuming all of these factors, and that's how we're advertising this interest rate. So what's important is that a lot of times we compare what maybe our parents' rates were or our coworker that just got a loan, and everybody's interest rate is different because everybody's scorecard is different. So somebody might have paid points for that rate, somebody might have gotten a lender credit for the rate, somebody's credit score might have been better, somebody may have refinanced instead of purchased. All of that stuff matters, and that's why I want you guys to be equipped with what really does matter so that you don't get the runaround and so that you're more educated when you're dealing with anything that has to do with interest rates, quite frankly. So the other thing that's interesting that I want to point to is a lot of this Fannie and Freddie stuff is public and all online that you can see right now. In fact, all you have to do is go to Google and type in Fannie Mae LLPA, and what you'll see is the adjustments. Let me see if I can pull them up here for you. So this is what it looks like. I know the screen doesn't fit it all, but if you come down here to this middle chart, this is one example, and it's here on the presentation for us, but this is all online. And so you'll see that the chart will show you based on just these two factors, which is your credit score and the amount that you're financing. So it works a little bit different than percent down. Here, for example, if you put 5% down, you're going to be in this column. And then if your credit score is a 740, there's already going to be a 0.25% rate adjustment directly from Fannie. That's before the banks get involved, based on the 5% and 740 credit score. Now, the worse your credit is, the higher that adjustment is. So credit scores with conventional loans is very, very important. It is one of the main factors. This other chart down here will show you if it's an investment property. You'll notice that if it's an investment property, there's a lot higher interest rates than if it's a primary home that you're going to live in. Now, all of these charts are online. There's literally 6 pages worth that you can scroll through and view. But what's interesting again is that all of this is public. So you don't just have to take the lender's word for it. You can pull this up and see the adjustments right from Fannie and Freddie. So I thought that was pretty interesting. So part of what I do as a mortgage bank, and many people ask me this, and then they usually ask me, well, then how do I get paid? Which I want to explain. But what's important is we are a mortgage bank, which is a little bit different than a retail bank. Most people are familiar with retail banks. Those are like your Chases and Wells Fargos. They have checking accounts, financial advising, business accounts. As a mortgage bank, all we do is write mortgage loans. That's it. And so how the rate market works is you have a pool of investors, like you see here, that buy mortgage-backed security bonds from Fannie, Freddie, and Ginnie. And so they're lending the money to Fannie and Freddie and Ginnie. And let's just say hypothetically, they're going to give these investors a 4% rate of return for lending them that money. And then what Fannie and Freddie do is they then lend the money to the banks, and they add a percentage because they want to make money off of the money that they're lending. So in this example, we added 0.25. So the banks are borrowing money from these Fannie, Freddie, and Ginnie at a 4.25% interest rate. So are the banks going to lend you, the consumer, at a 4.25% interest rate? Well, no, because they also have to make their money somehow. And so what the banks do is they add what's called their servicing fee or their percentage, so that's how they make their money. Let's just assume it's another 0.25. And so you, the consumer, would pay a total of 4.5% because this is the cost of borrowing the funds. And so what we do as a mortgage bank is we don't just represent one bank. For example, if I was a loan officer at Wells Fargo, the only product I could offer you would be Wells Fargo's products and rates. But as a mortgage bank, I have access to a ton of banks and a ton of loan programs. And what that allows us to do is to help find you the lowest interest rate on that given day so that we can ensure we find you the best rate, which is how I stay in business. My business is 100% based off referral of mouth. You don't see me advertised on billboards or on, commercials or anything like that. If I help my clients have a smooth transaction and find them the lowest interest rate, then they refer their friends and family to us. And so my number one job is to find the lowest interest rate, which is why I invest. Number one, I invested in becoming a certified mortgage planner. And number two, because I'm a certified mortgage planner, I have access to these tools and the software programs that allows me to monitor what's going on in our market, which in turn says what is causing our bonds to go up and down. The interest rates are directly tied to the U.S. Treasury bonds. Those are those pool of investors we just looked at. And so when the bond prices are high, interest rates are low. And when bond prices are low, interest rates are high. So a lot of us are more familiar with the stock market and the stock prices going up and down. Imagine the bond market, very similar to that, but just think of it as a bond market. And so when the bond prices are high, then interest rates are low and vice versa. And so what I have to do as your trusted advisor is I have to monitor the bond market because I need to know tomorrow when we wake up, is there something in the economy that's going to cause the bonds to go down, which therefore causes rates to go up. And when you work with just a regular loan officer, By definition, a loan officer, their job is to make sure that you meet Fannie and Freddie's underwriting guidelines, meaning they review your income and assets. They don't typically have a finance background because by definition, they're to make sure that you qualify for a particular loan. But as a certified mortgage planner, I have a finance background. In fact, I had my Series 6 and 63, and so we look at it from a financial perspective. And so the three biggest things in the economy that causes the bond market to fluctuate is GDP, the unemployment rate, and inflation. And so what you're looking at here is every week I get a snapshot of certain events that are going to happen for that week and when the feds are getting together and what is going to be talked about during that feds meeting. Then every Thursday I post on my business Facebook page, which is just The Mortgage Nerd. Every Thursday I post what Fannie and Freddie's interest rates are that Thursday because the report comes out every single week. And in this report, which is right here, you'll see a commentary from the economist that says what has happened to rates this week versus the last week. So again, we're being completely transparent. Every Thursday by noon, you'll see it, it's posted, and that's what Fannie and Freddie's rates are. So that's back to here before it gets down to here because that's what we need your scorecard for. Then on a daily watch and monthly watch, this is what I use. It's called Rate Watch to actually monitor the bond market every single day. So I'm looking at the bonds every day, just like a stockbroker looks at the stocks. Because if there's something in the event, let's say there's a jobs report coming out on a Friday and it looks like it's going to be better than what we were anticipating, then I know how to forecast what the interest rates are going to look like. And so this kind of stuff costs me a lot of money, but it's my competitive advantage to say why you want to hire me and my team versus just a loan officer that doesn't monitor any of this. And so to give you an example, this is one of my favorite charts. This is going to show you some examples of what the mortgage bonds and what the interest rates did in a short time period. And so you'll see in May 1st, 2013 to July 1st, so we're talking 60 days, the interest rates went from 3.375 and they shot up to 4.875 in a 60-day window. That is a 1.5 difference in the interest rate market. So if you can imagine, if you got pre-qualified May 1st and the rates were around 3.3, but you didn't go under contract till July, you weren't happy because the rates were a lot higher than when you got pre-qualified. And in this particular time period, we'd be communicating to our clients, hey, interest rates are going up. Now, there's nothing that you can do. You can't just go under contract tomorrow just because you know rates are going to go up. But you do want to be in the position and at least be aware of where the rate market is, and you don't want to be blindsided. In 2014, you'll see between September and October, so this is just a 30-day time period, the interest rates actually went down. It went from a 4.75 to a 3.75. So this is one of my favorite charts because this works in your favor. Let's say you got pre-qualified here and then went under contract here. Well, you're ecstatic because the interest rates moved in a positive direction for you. But that's why I always tell people, it's not just what the interest rate is today, it's what your interest rate is going to be locked at before you close on a loan. Because there's times where in this position here, people were going under contract, and normally when you go under contract, which means you signed a contract to buy the new home, we're locking your interest rate within a 24 to 48 time period. However, if I know that interest rates are going to go down, I would actually advise you to float the interest rate because the interest rates are going to move down. And so you always want the lowest rate before you close on your loan, not necessarily what the rate is for that day. And then next, this is what happened in just one day, because people think it's a sales tactic to say that rates fluctuate every single day, but they actually do. It's the bond market, and just like the stock market, they fluctuate. So in just one day in October of 2014, the interest rates went from 4.25 to 3.75 and then back up to 4.25, which is kind of crazy. But this is why it is so important that you're working with somebody that is monitoring the rates, because although mortgage rates are tax deductible for most of us, you always still want to get the lowest interest expense that you can. Next, I always like to point out, how familiar are you with the term points? So there's a term called points, and usually you pay points to buy your interest rate down. This is where in the advertisements, if you see a really low rate, in the fine print, it might say there's 2 points to get that rate. Well, buying points lowers your interest rate, but it increased your closing costs because you're buying the rate down, and vice versa. You can get a credit. So a lot of times, especially if you're going new construction, they'll say, oh, well, we can give you a builder credit of $5,000, or, well, it's true, any lender can do that. You can typically get up to 3% of your sales price, but it's just built into the interest rate. And so what I like to look at and point out in this chart, this is an example based off of $250,000, and this is showing you the change in the interest rate from a 4.375 down to a 4%. And so if you look at this, the cost or credit for the 4.375 is actually in red, which means it's a credit of $1,250. And the mortgage payment would be $1,248. At the end of 10 years, you would have paid just over $99,000 in mortgage interest alone. If you look at the 4.25% rate, that rate is a par interest rate. So that's why there's a 0, and the monthly payment dropped to $1,229. So if you look at that difference, that's 48 minus 29. So that's $19 a month. And so what that means is you're giving up a $1,250 credit at the closing table, which means you're having to bring an additional $1,250 to save $19 a month. At the 4.125, the cost of that point is now $1,563, and the payment drops another $19 a month. So now you're bringing $1,563 to buy the rate down for a payment that saves you $19 a month. Then you've got the 4% at that cost of $2,188, and the payment would be $1,191. So the question is, would you pay $2,188 of liquid cash today to save yourself a total of $38 a month when we look at the par rate? And so you have to run the break even on that. The break even is 115 months. That's what you see here. Well, 115 months, I mean, heck, that's almost 10 years. Statistics show that people stay in their house on average. They either sell their home or they refinance in their first 7 years. So although this is the lowest interest rate, and we're always programmed to select the lowest interest rate, does it actually make the most financial sense if you won't even save $38 enough a month to break even on it? And so that's one of the things that we look at from a certified mortgage planning standpoint, is we're going to show you, once we lock your interest rate, we're going to show you the best 4 options. We're going to run the break even. We're going to show you what your net worth will look like in 7 years. Because again, I believe in being transparent, but I also believe that our community and our country needs a lot more financial awareness than what they get. And every client deserves to have a certified mortgage plan presented to them when they're buying a home. This is usually the largest asset that you own. So we take that very seriously, and we're going to find you the best, but then equip you with the tools to figure out, should I take the 4% rate or should I take the 4.375? We're going to help you through that decision. Again, this is just an example. This is not a rate quote or an advertisement for rates. I just want you to see how the credits and points and payments and all that stuff works. So I hope you guys enjoyed this presentation. I really appreciate you taking the time to watch it. It's going to definitely help your mortgage experience, so that when you are able to go under contract, you have a better idea of how the rate market works. Again, if you have any questions, just let me know. And thank you again for giving us the opportunity. Take care.